Last week's GDP data surprised the market with a better than expecting of 3.3%. But the core PCE, which is, Federal Reserve favorite interest rate gauge, came no shock at all, like 0.3% month over month, as expected, showing there is no any clear signal from the Trump's tariff. And I think suppliers are taking the cost for themselves because of the weaker demand. And the consumer sentiment showing weakness, giving that extra edge for the Fed Reserve to cut interest rates. And we will be discussing all that and what happened about this week, and we'll predict, as usual, about next week's upcoming data and what it means to the market. And stay tuned. So let's address the elephant in the room. The GDP. The GDP means gross domestic product, which means an economy produced over a year, basically. And that came as better than expected. That shows there is a resilience in the US economy, giving that variable to not cut interest rate. Let me tell you why. Because a lower interest rate is inflationary. With this robust economy in the data shown, that will make things inflationary. But the labor market is significantly hit. And that data is shown, not just like hit. The whole Fed mostly was like, no way we're going to cut. After that data, even Jerome admitted it's going to cut in the Jackson Hole speech. That is so powerful. The labor market is significantly downside risk, making the September cut a pretty reasonable chance, about more than 85% at the time of speaking. And the core PCE, personal consumer expenditure, one of the favorite tool of the Fed to gauge inflation, didn't really show any crazy signs of going upwards or downwards. There's nothing that crazy, which gives that another additional variable to cut interest rate. But since the GDP is contradicting, now it's all focuses to one thing: the next week's NFP data specifically, or unemployment data that are gonna be released next week. So if any of them show any weakness, there is a guarantee of 25% cut. Like CPI wouldn't be even in a question. CPI wouldn't even be a question. But if there is no any surprise or like craziness about the labor market, the next week there will be CPI release, and the core CPI will be very crucial for the next cut or not. And this week's big theme was the September cut. Everybody was talking about September cut. Like everyone is really concerned about September cut. And the August's price action is crazy because everybody's thinking of there will be a cut or not, because this is very major and fundamental. And most day traders are even struggling to make a dime off of it because there are too much uncertainty in the system, and the geopolitics playing a very crucial role too. So what to expect on the next week? The next week is very crucial because there are a lot of labor market data will be released, especially the NFP report is very, very, very crucial, and it's going to cause significant change in the market. Even it's Friday with low volatility. No, don't fool yourself. That thing's going to be crazy. So what does it mean for the market? The DXY will be significantly changed. If there are prior data of unemployment, ADP unemployment and such, those data show very sign of weakness. There will be a major weakness of a dollar, which means sell the US dollar against pairs, most likely with euro and JPY. And gold will be very significantly upwards because it's against dollar, and there's inverse relation with the interest rate expectation. So the lower interest rate, the higher the gold. And the geopolitics at the table is going to fuel that up. So let's close this up. Even though the inflation is not well above 2%, the market sentiment, this is very crucial, is all about the next cut and the weakening labor market. So if that is confirmed in the data, the market is going to be directly position itself to the weakening dollar. So what do you expect and what do you have thoughts? Please comment down in below. And this is African Socrates. I will see you next week.